The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Good morning, everyone. Welcome to Money in the Morning with Mitch Goldberg. Let's get the weekend edition started. Dow futures up 118, S&P futures up 20, that's up about 0.5%. NASDAQ futures up 74 points, up 0.6%. Stock market is continuing its bounce yesterday. Yesterday was a pretty good day, finally had a bounce, and we're actually looking at an up week this week. Mind you, in spite of the amount that the market was down last month, Dow was off about like 4% last month. It still has not been a particularly volatile year. Like, we've had a couple of mildly big and a couple of mildly down days in the market. Like, you know, but like last couple of days, you were down like 350, and you know the news was like, oh, Dow has its worst day in like a month. But we haven't had these 1,000-point plus days, the really attention-getting ones. Keep in mind that, if everything is boring and ho-hum, it's not as interesting. So, but I don't mind ho-hum. I actually work hard to make personal finance and investing kind of boring. And we are going to geek out on a couple of things today about things that you don't know about, but you should, because it's the stuff that is literally, practically running your financial life. Okay. So we're going to get into that. And we are looking at yesterday's market. So the Dow yesterday was up 340. NASDAQ was up 0.7%. That's 83 points. S&P was up 30 points, up 0.76%. I like to give you the number and the percent because, there are still people who think, oh, wow, the Dow is up 300 or down 300. There are still people who think that's a huge thing. Yeah, when the Dow is at 6,000, a couple hundred points is a big deal, but the Dow is at 33,000. So, you just think in terms of percentages. If the Dow's at 33,000, then you know that 330 points is 1%. The S&P 500 is at 3,900 and change. Let's call it 4,000. It's almost 4,000. So, 40 points is a percent. And when you start to think in terms of under a percent, over a percent, in terms of movement in the major averages, that gives you a much better idea, quick, back of the envelope thought process of what kind of day, of what kind of day it really was for the stock market. And in real time, oil is down $1.52 per barrel for West Texas. That's a pretty good drop right there, down 2%. And the 10-year yield, which we focus on constantly, just dipped back below 4%. So bonds are catching a bit. Remember, if people are buying bonds and bond prices go up a little bit, their yields go down a little bit. 4% is that magic number for the 10-year yield where people say, inflation expectations are running higher or lower. The economy could really slow down. There are so many. And when I say slow down, is that there are so many interest rates, in particular the 30-year mortgage, that are tied to the 10-year yield. So when you follow the 10-year yield, we call that the benchmark for the bond market, for the global bond market, especially for the U.S. bond market. It's kind of like the S&P 500 of the stock market. We follow the S&P 500 mostly. By the way, the S&P 500 is indicated to open up at just over 4,000 on the S&P. Again, when I tell you these quotes on the S&P futures or any of the market futures, this is just a snapshot of how it looks for the market to open. This does not mean that the markets will trade that way the entire day. They could wind up doing a lot better. They could wind up doing a lot worse, and anything in between. You can't invest directly into an index, but you could invest directly into a security that tracks or mimics an index, by the way. And if you hear me say that a lot, it's because it's true, and I kind of have to say it to please the regulatory bodies, because this is a show about the market, and I am giving a lot of knowledge here, and we have to make sure it's interpreted appropriately. That's why I don't give out like specific stock recommendations on the show, because as a financial advisor and fiduciary, it's really my job to know the person in front of me before I give specific advice to their situation. So if you want to know why, like, somebody on CNBC could talk about individual stocks and I can't, it's because I'm acting in the capacity of a fiduciary financial advisor, not as a specific stock analyst based on that. I hope that makes sense to you, but that's really what it comes down to. So up week, couple things to talk about that you need to know that's much more important than just what the Dow is doing this moment. Before we get into that, I guess I should go over this. Procter & Gamble was up $2.27 yesterday. It's up another $1 today. Caught an upgrade. I think JP Morgan upgraded it and says they're about to become an earnings compounder. I've never heard anybody use that expression, an earnings compounder, but I guess to sum that up is Procter & Gamble has done a lot of cost cutting, made a lot of investments in technology and innovation, and now with a just holding steady, their earnings have a lot of opportunity to go up. Okay, Costco, which was up $7 yesterday, earnings, but today it came down, earnings not as good as we thought. So Costco is down almost $10 a share now at $4.76. Again, it was up 7 yesterday, so it's down almost 10 today. So net, you put that together, it's off a little bit. The reason I bring up Procter and Costco is they're tied into our lives. They're just such, consumer powerhouses. I mean, if you don't have a membership at Costco, then you know someone that has a membership at Costco. Incidentally, Costco's earnings are steadier than other retailers because like 90% of their profits come from their membership subscription, not from the stuff that you buy in the store. It's like they have good deals in the store to keep people renewing their membership, not to get people to renew their membership so they could have they could sell you more stuff. And they want to do both, but that's how that's the model for Costco, and it's a very good model. It works for them. So the big thing that you need to know is this terminal rate. We're going to get into a little Wall Street language that you need to know, that you hear every day. And this is part of the investor personal finance education. Okay. The terminal rate, okay, is at what point does the Fed stop raising rates? So, what will that rate be? Will the Fed stop raising rates when it gets the federal funds rate to 5%? Right now, the rate on the federal funds rate, which about a year ago is when they started hiking rates, is a target between 4.5% to 4.75%. The federal funds rate is always a target rate. It's usually within a quarter point, right? It's always been within a quarter point. So 4.5% to 4.75. We expect that rate to go up a quarter point 2 more times. So the rate will be 5, 5.25. Then maybe 5.25, 5.5. And at that point, most Wall Street strategists expect 5.5% to be the terminal rate. And at the terminal rate, the Fed would be neutral, where the downside risks to the economy and the upside risks to the economy are about equally weighted, and inflation is more firmly under control. Now, though, the more and more people are starting to lean to a terminal rate as high as 6% on the Fed funds rate. And that means you're getting 5% plus on money markets. like commonly, not just like one special money market, but that'll be a common money market rate. And first of all, at that point, there's a lot of incentive to just leave money in the bank because you're getting paid to wait. That is a competitor to the stock market, and all those people decided to jump into dividend-paying stocks because they were making nothing in the, in their checking account, their savings account, and CDs. Those I call those people yield chasers, and this happens every cycle. I'm doing this for 33 years, and it's like the same people get burned over and over and over. All right, so we need to know that the neutral rate and the terminal rate, and that's why there's so much confusion in the stock market, because investors are just confused. They don't have the certainty of knowing what the terminal rate will be. And that's what is the big driver of the ups and downs. Again, it has not been a crazy volatile year, but it's kind of boring actually this year. So let's follow up with some more terminology, and then I want to talk to you about something about credit cards that you need to know. You're listening to Money in the Morning with Mitch Goldberg. Thank you for joining us on LI News Radio 103.9 FM. We will be right back. More good stuff coming to you. You're listening to Money in the Morning with Mitch Goldberg. Welcome, and we so greatly appreciate you taking the time here at 103.9 FM LI News Radio. Here to check out more about myself, and if you want to take this conversation to a one-on-one basis, just to touch base, shoot the breeze, you can catch me at moneyinthemorning.info. And right now I'm in the process of uploading all of the previous episodes of the show onto it. And I'll have those out on it hopefully this weekend. It's a lot. And every day you put it off, the work just gets more and more. But I really want to tackle that. So, and in any event, I hope you'll take a look and check out moneyinthemorning.info, and that'll take you to my website for my firm, Client First Strategy, where we are financial advisors and planners. So let's get more into the vernacular. We talked about terminal rate and the neutral rate. You need to know this because you hear this a lot, but you're going to hear it more and more. And when you hear the analysts, they're going to talk about this, and you're like, oh, this is like over my head. I don't get it. Should I invest or not? What's going to happen to my retirement? Am I going to be able to afford to retire? Am I going to run out of money in retirement? These are the things that you care about. These are the things that I care about. But when we understand the vernacular of Wall Street, what these guys are saying and girls, we need to know. Neutral rate is the point at which the Fed, feels that its interest rate policy is balanced between upside and downside to the economy, and inflation is under control. Similar to the terminal rate is at which point the Fed stops raising rates. We don't know where that's going to be yet, but it does feel like that rate still has to go up a little bit more. But then there's a cohort of people who think that inflation will start to moderate in the middle of this year. Now, I keep hearing this story for over a year now, a year and a half. Inflation's going to moderate. It has moderated from its peak, but it's still too high for anyone's preference, including the Federal Reserve. Okay, so that's what you need to know. So while we're talking about the Federal Reserve, this is what I want to geek out on. And just a quick programming note. I was going to have James Medore, economics writer at Newsday, on the show today. He sends his most sincere apology. He had to cover a potential emergency thing today, and I don't blame him. And everyone at Newsday has literally profusely apologized to me, with such respect. And I appreciate the apologies. It's okay. It happens with guests. I've had to do that. It just, stuff happens. I think you could put that on a bumper sticker. Stuff happens. Okay. Let's talk about the Federal Reserve with the time we have left. You should know about the Federal Reserve because you keep hearing the Fed, the Federal Reserve. what is it doing? It's this, it's that. The Fed branch governor said this, the Fed branch governor said that. We just need to geek out on this because you need to know what the Federal Reserve is, and you need to, you hear about this constantly. But if I ask, 10 people what about the Fed, a few people will say it's the central bank of the United States. But most people don't know a lot about it. I do, and I want to share this with you in a couple of ways, in ways that will help you understand what's going on here. What is this Fed? Who are these people that are like running our financial lives, it seems, every day? So the Federal Reserve is the central bank of the United States. Every country has a central bank, and ours performs 5 general functions, okay, that are all generally they're in that are in the public interest, the best interest of the public. It conducts its monetary policy, and that means it changes interest rates, pulls money out of the economy, adds money to the economy with interest rates, and that's to do 2 things. It's got a dual mandate: promote maximum employment and stable prices. That's the inflation component. The Fed's mandate is actually not to get inflation under control. It's to promote stable prices. And you can also add to this moderate long-term interest rates. Okay? That's its job. It works in a lag. It does its best to get ahead of things, but rarely does the Fed get ahead of issues. It's kind of reacting to things in the economy. And sometimes it stays on a path that it thinks is good for the economy, and it overdoes it, like keeping rates too low for too long and printing too much money, and that helps make future inflation even worse than it would have been. Okay? So it promotes stability of the financial system, and what that means is it seeks to contain systemic risk. So if a big bank goes out of business, or if there's a problem in the credit markets where all of a sudden banks are worried about the economy and their own balance sheets and they stop making loans to everybody, then that stops the economy. And everything, even payroll, everything has to do with short-term credit. Not to say that your employer or you as an employer is borrowing money, but when you send your money to the payroll company, they're trying to make interest on the money, and then we don't want that money to get lost. Anyway, it promotes stability of the financial system by helping it operate in areas where it could be breaking down. Because if one part of the financial system breaks down, it usually spreads. We call that contagion to other parts of the financial economy. So if the financial markets break down, if the bond market breaks down, or a giant bank goes out of business, or a big regional bank goes out of business, that will have an impact on other banks and consumers and businesses around it. So the Fed will act to say, we will run that bank, we will provide liquidity, we will make sure everybody's bank accounts are okay, and we'll get through it. And then we'll come up with new laws, rules, and regulations to help prevent that from happening again. So the rules and regulations of the banking system, they're always a work in progress. And, the more things that go wrong, the more rules and regulations that we come up with to help prevent these from happening again. That's their job. Okay, that's what the Fed does. The Fed actually oversees the whole banking system of the United States. It promotes the safety and soundness of individual financial institutions. Again, it monitors their impact on the financial system. Generally, if a bank does fold, the bank, let's say, we'll call it Bank National. If Bank National fails, it'll become Bank National of the Federal Reserve System, and then the Federal Reserve will take that bank and they'll literally give it to another bigger bank to run it and fix it. And the Fed will indemnify the new bank, the bigger bank, against any problems it has. Okay? To make sure that everybody's okay, because you don't want to worry that the banking system is going to plunge. You don't want to worry about a run on the banks. A run on the bank is this. Let's say a bank has $200 million of deposits, a small bank branch, but maybe they're only keeping $2 or $3 million of that money in the bank. The rest of it is out for loans. Or the bank invests the money in interest rate bearing securities. That's how the bank makes money. That's how it pays you an interest rate at the bank, even if it's slow. But if everyone decides at one time in that bank branch to take their money out, that's a run on the bank, and the bank branch folds. If that happens to like an entire bank, not just one branch, the bank goes out of business. It folds immediately, and it has to be rescued. The reason why people take their money out of the bank en masse would be a loss of confidence in the banking system, and they feel that their cash is better under their mattress than in the bank. The Federal Reserve steps in to help with that. And then it promotes consumer protection and community development. There's a lot more to it, but we are out of time, so I'll continue this on Monday. Happy Friday. Have a wonderful weekend. Thank you for joining us at Money in the Morning with Mitch Goldberg. You're listening to 103.9 FM, LI News Radio. Stay tuned for more homegrown programming. We greatly appreciate you sticking with us and, making a great weekend. Talk to you Monday.
Securities and investment advisory services are offered through Next Financial Group Incorporated, member of FINRA SIPC. Client First Strategy is not an affiliate of Next Financial Group Incorporated. All the views expressed are those of Mitchell Goldberg and Client First Strategy and not those of Next Financial Group Incorporated. Views are general in nature and not intended to be investment advice. Any discussion of individual securities should not be construed as a recommendation or solicitation by our presenters. Next Financial Group Incorporated does not provide tax advice.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Good morning, everyone. Welcome to Money in the Morning with Mitch Goldberg. Let's get the weekend edition started. Dow futures up 118, S&P futures up 20. That's up about 0.5%. NASDAQ futures up 74 points, up 0.6%. Stock market is continuing its bounce yesterday. Yesterday was a pretty good day. Finally had a bounce. And we're actually looking at an up week this week. Mind you, in spite of the amount that the market was down last month, Dow was off about like 4% last month. It still has not been